Hey everyone, this is a trader investor, and in this video I want to explain to you why I call myself the trader investor, and not specifically the name, but is there a difference between investing and trading? Why is it that both of them can be used in conjunction? Are there any similarities and any differences between the two? This is really the focus of today. This is what I want to spend some time on. It's just a short video so that you can understand where I'm coming from, and you can also use it for your own financial needs. And by financial needs, I don't mean using it as a recommendation, but using it as a way for you to view your future outlook, where you want to head, what you want to do with any kind of investing or trading. So that's why I want to explain the difference between the two, the similarities, and then it will help you make a decision accordingly. So let's dive right into it. And as you can see in this Venn diagram, I have put it investing on one side, trading on the other, and then there's that middle ground where the two are meeting. This is where we will talk about similarities. But before we talk about similarities, it's good to talk about differences. So investing is the idea of buying some asset class, whether it is stock, whether it is commodities, futures, real estate, art, jewelry. So the idea of investing is buying some asset class for a long-term hold. You have a long-term outlook. It's not get in today, get out next month, get out next year, but at least 5+ years of holding period, and preferably even 20+ years is the idea of investing. So when we invest, we're investing for the long haul. It's not a quick in and out. And when you look at investing, the daily price fluctuation of any asset class that you have purchased is irrelevant. Weekly price fluctuation is irrelevant. And sometimes even monthly price fluctuation is irrelevant. You are looking at year over year. Is this asset giving me an upward return? And not to cash out, but to hold for a long hold. For a long hold, this is really the main purpose of investing. On the other hand, trading is the idea of buying an asset for a quick turnover, for a quick flip. So think of it as flipping houses, for example. You might have seen a lot of TV shows about flipping houses. So the idea of flipping houses is you buy something, you fix it up real quick and flip it over, and then repeat that cycle. Buy it, something else, repeat the cycle. Buy something else, repeat the cycle. That's the idea of trading in real estate, and it's very similar in the stock market, in futures, in commodities, in options. The idea is you buy something for a very short-term hold, and short-term has a meaning that is different for different people. Short hold doesn't mean minutes, or it doesn't mean days. It just means whatever is short-term for you, but definitely not the 5+ years I've mentioned in investing. So trading, most of the time, trading, we think of it as get in and out the same day, get in and out the same week or the same months. In terms of stock trading, it's called swing trading, when you're holding it for a couple of days or a couple of weeks or months. But similar to flipping houses, the idea is you buy something at a price that is low enough for you, and you sell it at a price that is high enough for you. That's the idea of trading. And one other big difference, many times trading is to generate quick income, and investing is to generate retirement, some wealth for down the road, many times. So one of the biggest similarities that I have found between the two is you can trade to build long-term wealth. You don't have to take the cash out every time you trade. You can just keep building and compound your gains like a snowball effect to keep increasing your investment portfolio. As a result, your trading becomes a vehicle that you use for investing. So instead of trying to pinpoint, let me find 5 to 10 companies that I really believe in, or it could be 5 to 10 ETFs or any mixture thereof that you really believe in and hold for 20 plus years, you'll just say, what is a company that I believe in for the next few minutes or the next few days, the next few weeks, and you get in, get out. As you grow your account, you keep repeating this cycle over and over, and you keep growing your portfolio. So in this context, if you use trading for long-term wealth building, it's almost the same as investing, except you're in and out quicker, but to keep building. If you use trading for income to generate, whether it's primary income or supplemental income, then it's completely different, because every time you gain a certain amount, whether it's at the end of the week, at the end of the month, or at the end of the year, you're pulling some capital out of your trading account because you need that to supplement your income, or you need that as your primary income. That's what you use to live off. So this is why the two are kind of similar but kind of different as well, right? This is really big. The big difference is, do you keep pulling money out, which makes you a trader, a professional trader. By professional, I don't mean you're licensed and you're trading for somebody else, but for yourself, you view trading as a profession, and you're trading to either supplement or have it be your primary source of income. Or you're using trading as a vehicle for your long-term wealth building. So the reason why I call myself trader investor is I do both, meaning both in not as a primary income, but really to provide additional source of income when I need something to add to the family. When I, for example, if I want to add a toy, I can go to trading, or I use it in my investment account. I use a portion of my investment account to trade and grow my account a little bit faster than just the investing on the buy and hold section. So that's why I am both a trader and an investor, because my outlook is short-term gains to keep building that wealth, short-term gains to pull money out when I need something that is different than the normal expense. So I don't have to tap into credits or anything like that, so I can do that. Or short-term gains again to keep building my investment portfolio. So as a result, I am both, right? And I'm just not one nor the other. I am both of them, and I'm happy to be both of them because I use it for different purposes. When I just want to grow one account, I'm a trader for investing purposes. When I am trading a certain account to pull money out when I need it, then I'm just a trader for that purpose. And I'm not looking for that specific account. I'm not looking to grow it beyond a certain level. I don't have any target. I must get this account to this size because I have my investing account to take care of for the size that I want. So on the trading side, I'm just focusing on, if I need something, if my family needs something, where can we go to tap into additional source of income. It's almost like saying I push a button, I make income. It's not that easy. Trading is not something easy. I'm not suggesting that every morning I wake up I can pull cash out of the market. That's not what I'm suggesting. As you have seen in many of my videos, there are times I make mistakes. There are times that I enter in the right direction, but the market decides to turn on us. I think Thursday was a very good example. On April 22nd, 2021, when we had a very bullish market, the market was really trending up for most of the day, but then our president Joe Biden came out and talked about 40%, nearly 40% capital gains tax. As soon as that word came out, the market collapsed. By collapse, I mean in relation to that day itself. In relation to that day itself, I think it was about a 1.5% drop for that last hour and a half or so of trading. But the very next day, again on Friday, today, the market recovered those losses. And so something like that could happen, and you could be caught on the wrong side of the market. But that's the nature of trading. There is no system that is 100% guaranteed. We do not control where price goes. We only control our risk. The market makers, the institutions, the banks, the hedge funds, the pension funds, they control where they want to take the market because they have the deep pockets and they don't have to have stops. They don't have to take losses. They can wait for price to reverse. They can take the price in any direction that they want. And so since we don't have those pockets, we have stops. And our stops will get triggered and we'll have losing trades. Sometimes we will have consecutive losing trades. That's the nature of this game. And in trading, the goal is to be consistently winning, not to be trade by trade winning. And so as we trade, it is a hard business. We have to put a lot of focus, and when we're consistently profitable, then as we need cash, we can pull cash out. Or as we need to live off that account, we can pull cash out. And so that's why it takes many people a few years while they have a 9 to 5 before they can be in a position to take this as their full-time job. And you don't need to have this as your full-time job. Trading can be fun. It can happen even if you love your 9 to 5. You can still be trading and grow your investment account in trading and grow your small account for when you need that push button. I need cash for XYZ. So that's why it is important to understand the difference. It is important for you to decide, where do you sit in this picture? What is your goal? Is your goal to grow an account for retirement? Or is your goal to grow an account to pull cash out? Or is your goal to do both of them? Once you understand this difference, once you understand where you want to be, the key part is you. Once you understand where you want to be, this is where it is important to take action and to have your account size that will fit that decision. And just like trading, investing could go wrong. What if you pick 10 companies, but 5 of them go bankrupt? Right? It's the same risks that we take. That's why we have to really be patient on when we add to positions, when we take away from positions. One of the things that I suggest is have a portion of your account be tied to the broader market, That way you're not tied to a single company's earnings, you're not tied to a single company's whether they do well or not, whether they have margin of safety, whether they have competitive advantage. You're not tied to that. And so a portion of your account, this is what I do, a portion of my account is in the broader market. A portion of my account I use for picking specific stocks. I have different fundamental strategies that I use, and I'll go over some of my fundamental analysis criteria in a future video, because it's important for you to understand how do you select companies to invest in, and not just be a herd. And just because Bloomberg or CNBC mention a company, it doesn't mean you should blindly follow. You can follow them if you have done your due diligence. If you believe in that company, fantastic, you should follow them. If you don't understand that company, I highly recommend you study what that company is about and why do they have a competitive advantage. Why do you trade them? That's, I think it's important. When people ask me, hey, what do you think about company XYZ? If I don't know the company, the first thing I'll say to them is, I have no idea what this company does. Therefore, I cannot give you an informed, knowledgeable analysis. So, either I take time to go find out about that company, or that person knows more about me. Therefore, my analysis will not be useful to them. So understand the difference between trading and investing. Understand where you sit in the big picture, what your goal is, and then have your accounts funded according to your needs. And by account funded, I don't mean have big accounts. Of course, the bigger your account, the faster you can cumulatively grow your account, because that's what trading is about. That compounding effect is what really makes your account great. But wherever you are in life, start with what you have. But know the difference. If it's to supplement income, what amount of capital do you need to be able to generate the type of income you need on a monthly basis? And that is something that you discover through your trading experience. Once you trade enough and know, okay, consistently, I can grow my account by X amount every month. Once you get to that consistency level, then you will understand, okay, this is how much I need in my account in order to have that percentage be my monthly expense. So that's important to know that. Until you get there, don't just sit on the sideline, invest your money. At least grow that money better than a savings account, better than a CD account. So invest it, whether it's in the broader market or in specific stocks that you pick, in whatever form you want to use. At least grow your account. Don't just sit on the sideline. Sitting on the sideline or having fear to invest is as good as throwing away money. So the only way you get ahead in life is to take risks and invest your money and let your money work for you. Money makes money. That concept where they say money makes money is because when you invest, it generates you more income. So money makes money. So be investing at the very least if you're not trading. But understand the difference and know what you want to do, what you want to achieve. And based on your goal, based on what you want to achieve, set up your accounts accordingly. So this is just, a brief tutorial on the difference between investing and trading, where you want to be and where you want to head. It's critical to understand that. So this is brief, I know, and I hope it has been helpful. I'm always open to sharing more ideas. Let me know what you want me to share about, what additional information you want me to provide. And as always, don't forget to like this video. keep encouraging me, and I will see you in the next video where I will do some analysis. And I know this has been just a little bit different style, but I will do some analysis and go over markets. And on a final note, actually, before I forget, so what I want to do before I let you go is something that I wanted to show you, the big difference between the long-term hold and the short-term hold. So if you look at the SPY as an example, let's take this out so it doesn't confuse. If you look at the SPY over long term, you see some fluctuations, but these are monthly fluctuations. This is a monthly chart. Now, if I turn this to a daily chart, you'll see a lot more fluctuations that you're not really concerned with over a period of 1 month. So, you know, if we are to put some indication, let's use the vertical line. Let's use beginning of September 2020, and let's draw another line at the end of September, and we'll put it on October 1st. And if we go to a monthly chart, on a monthly chart, that's just one line, that's just a blip in the overall trend. But when you go to daily, it looks like there's some huge volatility. It looks, oh, price dropped this big movement in price in 1 month, but on a monthly it's just one bar. And so that's why it's important to know what you want to do. And once you know what you want to do, how you want to invest, then you can take a look at longer time frames, right? This is what you want to focus on. So I just wanted to go over this portion so that you can understand that the daily fluctuation is irrelevant to you if you are an investor. All right, everyone, take care, and I'll see you in the next video.